Hey, if you're looking for a life insurance policy, maybe you were introduced to neither the term insurance or the whole life insurance. However, maybe you want something on the permanent side, but you are on a budget. You might wonder, is there anything in the middle? Something that gives you the protection of a permanent insurance, but is more cost effective and flexible compared to the whole life insurance? And the answer is yes, there is. There is another option called the universal life insurance. So in today's video, I want to talk about what is universal life insurance, who is it for, and more importantly, what is the proper way to set up the plan so you have a better idea if universal life insurance is right for you. And as always, if this is your first time here, thanks for dropping by. My name is Thomas, and this channel is to help Canadians to make better choices on retirement, wealth, and insurance. My goal is to make sure you can take one or two ideas home so you can make better financial decisions onward. So if this is something that you're interested in, make sure you click the subscribe button below and you will never miss any of my videos. Let's get started. In Canada, when you're getting life insurance, there are essentially two options. You can get a term that expires at a certain age, or you can get a permanent option. The downside to any term life insurance is that they expired, usually at the age of 80 to 85 depending on the insurance provider. That means you might get a nice lump sum of money if you do pass away before the age of 85, but what happens if you die after? There are a lot of fees, expenses, and more importantly taxes after death, and if your life insurance expires before you died, then you have no guarantees your costs are covered. So in a sense, term life insurance is a temporary solution to a permanent problem, and that's why I want to tell you more about the permanent side. When it comes to permanent life insurance, there are once again two options: whole life insurance and universal life insurance. Universal life insurance is a form of permanent insurance that is ideal for people who want flexibility. It's also ideal for young people who are a bit tight on the budget but still want a life insurance. In a nutshell, whole life insurance is like a piece of property in the insurance world. It has more guarantees and you can predict the growth. However, it requires more capital and commitment, and the rate of return is relatively low as it depends on the company's dividend scale. Where universal life insurance is like investments. That's because you don't just have the insurance, you also have a savings component. Therefore, it's like a middle ground between insurance and investments. You can control how much you want to put into the plan, and you have the options to not put it at all, which I will explain later. Now, let's briefly look at the background of universal life insurance to understand better why it exists and what's it for. Universal life insurance was introduced about 40 years ago. Back then, only whole life insurance existed. Back in the 80s, the stock market started to get more and more attractive for people because they would get a much higher return there. So a lot of investors or business owners were like, hey, the stock market can give me 30, 50 or 80% return, where if I just put it in a savings account or the whole life insurance, I'll just get 10. Also, I have to put away that money. I have no idea what the insurance company has to do about it. So therefore, more and more people are steering away from the whole life insurance, to the point where the insurance companies had to come up with a product where instead of mixing all the savings and insurance together, why don't we bundle the plan and let the client to choose where you want to invest. So you get to have life insurance and also the flexibility of investment and with a tax advantage. It makes everyone satisfied, hence the name Universal Life. It became popular because of the high transparency. You know exactly the cost of insurance and how much you put into the investment, where whole life insurance is kind of like a black box. You don't know what happens to that money. And especially before 2009, before tax-free saving was introduced, a lot of investors love it because the money in the insurance plan can grow tax shelter, and if it's done right, it can be tax-free when they withdraw the savings from it. So who is it for? Universal life insurance is ideal for anyone who likes to invest, who is relatively young, tight on budget, but wants a permanent life insurance. Let's say you want to have a $500,000 of life insurance. You are a 30-year-old male non-smoker. A whole life insurance will probably gonna cost you around $400 to $500 a month. But universal life insurance can start at $150 per month. Therefore, it's great for people on a budget. And you might wonder, why such a big difference? And that has a lot to do with how you structure the plan. First, we need to understand universal life insurance has two components: the insurance and the investment part. they are separate, and you know exactly how much money you're going to put into the investment and how much into the insurance part. So for the cost of the life insurance portion, there are two options. You can choose between level or yearly renewable term. Level means the cost of the insurance is fixed from now until the day that you pass away. YRT means that every year they will increase the cost of insurance as we are getting older. The beauty of YRT is when you're young, the cost of insurance is much cheaper compared to a level plan. And let me give you an example. John is 30 years old, married. He wants universal life insurance because he has the flexibility and he can choose how much he wants to put in. For a level universal life insurance, the cost for $500,000 is around $300 per month. Where if John chooses YRT, the cost starts at $60 per month for his current age, and the year after is around $62, and the year after maybe is around $65 per month. Yes, the cost of insurance keeps increasing, but it takes John to reach age 65 to start paying $300 for the cost of insurance. So which one should you choose, level or YRT? Using John's case, if his budget is around $400 per month and decides to do the level cost of universal life insurance, at age of 65, he will have around $140,000 in cash value and $252,000 at the age of 75 based on a 5% return on investments. But if John chooses YRT instead, the cost of insurance is $60 and he can use the remaining $340 for investments. And therefore, he will have around $400,000 at age 65 and $700,000 at the age of 75. So it really depends on your age and how much money you'd like to put aside. If you want to invest more and you are young, YRT will be a better option. And that's because we can leverage the youth to get the lowest cost possible and invest the difference into the markets. Where if you're hitting your 50s or 60s and want to lock down the costs instead of increasing over the years, then level will be a good option. Now for the investment portion, you have a variety of things that you can do. You can use it for savings, term deposits, bond, or equity-based funds. The range of yearly return per year can be between 1 to 20% depending on your risk and market performance. With the current low interest environment, I suggest investing into the equity fund like an index fund. It's relatively safe and it gives you a good return overall. Plus, you're doing this for the long term anyway. What's more, I always recommend making sure the universal life that you have is death benefits plus fund. Meaning, if you pass away, you get both the death benefits plus whatever that you save inside the plan tax-free. Now, let's dive deeper. The beauty of having a universal life insurance is that you can control how much you want to put into the plan. In John's case, he can choose to put in $200 this year, and he can also choose to put in $2,000 next year. Now, you might wonder, why should you pay more than the minimum? And that's a good reason to it. Think of this insurance like a coffee cup. Anything inside this cup is tax sheltered, so the CRA won't tax you on the portion of the investment. And depending on the size of the cup, whether it's tall, grande, or venti, it depends on the amount of the insurance coverage that you buy. And yes, there's a cost to this cup, but if everything is planned accordingly, the interest that you earn from the investment can cover the cost already. That means you now have a self-sustainable system and comes with a free insurance. Remember, tax-free saving increases the room by $6,000 every year. If you're a high-income earner, you should max out the room pretty quickly. So a lot of business owners or professionals like to buy a universal life insurance to create more tax buckets besides from the tax-free saving or the RSP. And that's why universal life insurance is also called the rich man's tax-free savings account. Another great feature of universal life insurance is something called the premium holiday. Let's assume you pay into your insurance plan for a few years, but suddenly unexpected expenses coming up. Maybe you have to buy a place or you lost a job. In that case, you can use the cash value to pay for the cost of the insurance. On the other hand, whole life insurance have a similar feature, but it probably won't kick in unless you have the plan for more than 15 years. And that's why, like I said, whole life insurance is like buying a place. No matter if you're sick or laid off, you're obligated to pay the mortgage. Now, like anything, it has its downside as well. And compared to a whole life insurance, that is a lot of moving parts for the universal life insurance, especially if you're choosing the YLT option. The downside of having the YLT is that if you don't invest enough into your insurance plan, one day the cost of the insurance side will be much higher than the investment side. And I do see a lot of cases like that. The agent just sold a client a YLT-UL policy but put all the investments into a saving account. As a result, as the client is getting older, the return from the investment cannot cover the cost. And speaking of investment, because it's market dependent, think back in the 2008 or 2011, the stock market dropped around 30%. So therefore, most of the universal life insurance follow as well, where the whole life insurance is still able to pay 6 to 8% on those challenging years. Meanwhile, just like a mortgage, most of the whole life insurance now can be paid off in 20 years, where universal life you pretty much want to keep paying until the day that you pass away. Yes, you can access the premium holiday option, but that's the risk of policy lapsing when there's not enough money in the plan. If you're thinking about universal life insurance now, there are a couple of things to consider in advance. Do you want to choose YLT or level? What kind of investment would you like to choose? And more importantly, will your insurance advisor going to review the investment performance with you from time to time? Or you have those agents that never come back to review? I personally have both the whole life insurance and the universal life insurance because now I can have both for the world. But I do find universal life insurance is especially beneficial if you're young and looking for assets accumulation. It's transparent and you are more in control. Alright, as usual, hope you learned something from this video. Please share this video with your friends or family who are looking for insurance. And comment below if you have any questions. I need your feedback to make the video better. Hey, thanks so much for watching. This is Thomas, and I will see you in the next video.